is exactly the opposite of what you see for a financial asset, right? A financial liability, and because the word is liability, it is a contractual obligation to pay cash, or it is a contractual obligation to exchange financial assets or liabilities under conditions that are potentially unfavorable to the entity. And finally, you could also use your own shares as currency to settle a liability or an obligation. So financial liability is a contractual obligation to pay cash, right? Cash is going out, or settle it by issuing or exchanging other financial assets. Alternatively, we said it is a contractual obligation to exchange financial assets or liabilities under conditions that are potentially unfavorable to the entity. This is exactly the other situation where the market price of the asset is 15 rupees and I have told someone, I will sell the asset to you at 10. Alternatively, they could also be instruments that are settled in their own equity. This is basically an example where your shares or the entity's shares are used as a currency. Let's take one short example to discuss this concept, and it's most relevant when we talk of a financial liability. Let's take the example of a company which is going to buy an asset. Say the company wants to buy an asset. There are two options to buy the asset. One, you either pay cash to buy the asset, in which case it is a clear financial liability. In another example, basically the vendor says, look, I like your company. Why don't you give me shares of your company? So the company that's buying the car says, okay, fine, I will give you shares. Now the question is, how many number of shares, right? Because the price of the shares could keep changing. So I once again go back to the point that if my shares are to be used as currency, I will basically tell the vendor, look, the number of shares that I issue will change. It will change based on the market price per share, but rest assured, if your car costs 10 lakh rupees, you will get 10 lakh rupees worth of share. So here, the fixed for fixed condition is not met. The number of shares varies. To give you a contrasting example, if I told the vendor, look, I will give you 1,000 shares of my company, 2 months later, you deliver the car to me. Now in this case, the seller of the car is exposed to the same risk as any shareholder. Because if the value of the share goes down to 1 rupee per share, the company has bought a car worth 10 lakh by paying only 10,000 equity shares or 10,000 rupees worth. That is where the seller of the car bears the risk as if he's the owner of the car or of the company. So important to keep in mind, for a financial liability, if the liability is denominated in the entity's own shares, the number of shares should not be fixed. Very critical to keep this in mind. We call it as the fixed for fixed condition. We will talk a bit about this in more detail with more examples tomorrow. So right now, just keep the concept in your mind. We will look at the more specific examples as we go through the sessions tomorrow. So to summarize what we've spoken about of financial liability, it's a contractual obligation. Contractual obligation could arise under potentially unfavorable conditions. And lastly, but most importantly, you could also have instruments where the shares of a company are used as a currency in the transaction. If the number of shares is not fixed, then such an instrument is a liability instrument. This is typically where it gets a little complicated. The devil is always in the detail, friends. Please be very careful when you get such arrangements. We have not seen too many contracts with vendors or suppliers where settlement happens through shares. But very important to look at this kind of an arrangement. For example, you could have company A buying out company B, and then you say that, look, right now I'm buying only 80%, but later on I will buy another 20% from you. The settlement will happen through shares of A, of the buyer. Those could be examples where so one point we get is styling equity for capital equipment purchase is common. Sure, possibly, because if you have a large amount of equipment that you're buying, it could be possible. But it's important what company is going to sell this, because if you have a private limited company or a very small company, again the vendor may not be comfortable, but it's a matter of commercial arrangement. And that's why the standard keeps all types of enabling provisions in the standard. You will always find guidance for accounting whatever the kind of transaction that we see. Right. So we've spoken about what is a financial asset. We've spoken about what is a financial liability. What now remains